So again, you need to know the different types of real estate, the different classes of the assets. So for instance, types of real estate, there's 6 types. So you have office, you have retail, you have industrial, you have multifamily, you have land, and you have hospitality. Those are your 6 types of real estate, commercial real estate. And then within those, you have different asset classes, so you got A, B, C, D, right? So A is your newer product, B is your, a little bit older product. C is, obviously it goes down the scale, right? And, condition of property, area surrounding, and age built is what all those asset classes are all about. And so you got to look into that. And, they're about a 10 to 15 year gap between all of those asset classes, but a lot of it is the area as well. So you need to understand that. You need to understand cash, financing, and understand how cash flow works, how the financing of real estate works, how to raise money, things like that. You got to understand how to find deals. So what I always tell everybody is start local. Real estate is hyper local, okay? Meaning you can have an asset on one block that's worth X, and it might be trading at a very low cap rate, but you can turn the corner and go right down the street and you can't give it away no matter what the cap rate is, right? So real estate is very hyper local, in terms of demand. So you need to really understand your market. When I say understand your market, if you're in the residential game, you need to know how many properties are on the market, how long they've been on the market, how many are under contract, how long they've been under contract, how many have sold in the last 6 months to a year to 2 years, how long were they on the market, what did they sell list price to ask price. Same thing in commercial and multifamily. You need to know what is the vacancy rate, what are the going rents, what are the asking rents, what are the vacancies, what are the different types of assets, what are the cap rates on them, what's the demand drivers that are going to send traffic to that apartment building or to that commercial building, things like that. What do the demographics look like? Who lives around these things? Who's going to be frequenting these buildings? Who's going to be your customers and your client base? Who's going to be your tenants? Things like that. So you need to know those things. But to physically get started in the game, you got to do something. So you either have to find a deal, or you have to be able to find, raise money to invest in a deal, or have money to invest in a deal. And then you can partner with people that are doing deals. So that's really how you get started. And what it boils down to is if you're going to want to secure a deal and find a deal, you have to analyze a lot of properties. You have to make a lot of offers. That's where a lot of people go wrong, is they'll analyze stuff, but they never actually make an offer because they figure, well, this thing just doesn't work. Well, if you're going to go through the trouble of analyzing it, it doesn't cost you anything to throw an offer out there, for something, right? So if you're taking time to analyze a deal, go ahead and put together, if it's commercial, what's called an LOI, a letter of intent, and just put down where it needs to be to meet your return requirements, and just send it out and start that process. Start making offers, get used to it. If it's residential, same thing. You run the numbers, whether it's a rental, you can determine, working it backwards based on the income and your return requirements, how much you can pay. Same thing if you're going to flip it, what your after repair value is minus your repair costs, determines, what you can pay, after your profit margin is taken out and expenses. So you just really need to analyze and start making offers. And that's really where a lot of people go wrong, is they get stuck in the analysis stage, and they never actually make offers. And in this day and age, depending on the market you're in, you have to make a lot of offers to get a deal. So you got to get in the habit of just making offers. They can be verbal, they can be written, they're non-binding. It doesn't cost you anything. You're not going to lose any money to make an offer. Well, yeah. So when you're analyzing a deal, you have all the financial due diligence, and you have at least, somewhat inspected the property. Okay. So without an agreement in place, they're not going to let you physically walk every unit.
Yeah.
Some properties you can, some won't. Usually they want to wait. Multifamily, a lot of times they want you to be under contract before they'll let you inspect the units. But some properties, they'll let you go inspect units, depending on what it is. Commercial assets, you can go walk the property and see it. Houses, you can walk the property and see it before you make an offer. But usually you're going to have all of the financial information, all that due diligence to be able to formulate your assumptions of the cash flows and the financials of the property to see if it makes sense. And, let's say your parameters are, you need an 8 cap for something to make sense, and you get all of the information in, and what it boils down to is they're asking a 6. Well, if you need it to be an 8, just make an offer. Say, hey, look, here's where I need to be. This is what I can do. These are my parameters, and you just make an offer. It's contingent upon, all the inspections and all the criteria and everything meeting. So, now that being said, that's on assets that are out there and have been for sale for a while. Okay, if you've got competitive assets and there's multiple bids, multiple offers, well, then there's no point wasting anybody's time in making an offer. So I will qualify that by saying you want to make offers on stuff that is for sale and has been for sale for a while, and there's currently not a bunch of offers on the table. If it's a
Okay.
competitive product and you're going to compete, then you can make a competitive offer. But
Yeah.
in terms of making offers that are within your return parameters, you want to make sure it's something that hasn't sold yet and has been for sale for a while. Well, not necessarily. I mean, there's deals at every level. Okay. So, and some markets are hotter than others. So to just, and there's a lot of competition, period, but there's
Yeah.
always deals. But so the better assets right now, the bigger, better assets, there's a lot of pressure. There's a lot of competition, multiple offers, you're going to be competing. So that's one level. Okay. If you're just starting out, you're going to probably have a better opportunity to be more competitive or find off-market deals that aren't even listed yet.
Yeah.
Or you go after the deals, like I said, that have been on the market for a while. Maybe it was overpriced, and people are just ignoring it now. So then you go in, you analyze it, and you make an offer where you need to be. So, to get started, you want to look for those things, either off-market properties, you got to go directly to the seller. And, literally you got to pick up the phone or knock on the door and meet these owners of smaller properties, and develop that relationship, or go after properties that have been for sale for a while and just didn't sell because it's either overpriced or needs a lot of work or whatever it is. Generally, it boils down to the price, or it could be a bad location. So it isn't necessarily C or D. It's more of that opportunity there. It's either off market or it's been for sale and hadn't sold. Well, that's up to the individual. Everybody has their own return requirements. So a cap rate is a cash on cash return. So those are basically the same thing. So if a property is a 6 cap, that means if you pay cash for it, you're going to earn 6%. It's a capitalization rate. So that's what you earn on your capital that you use to pay for the property. That's what I call a cap rate, capitalization rate. Internal rate of return is different. That's a return calculation on the money invested down over a period of time. So if you've got a 3-year, 5-year, 10-year hold and you put $100,000 down, that's that cumulative return on that $100,000 over that 3, 5, 10-year period. So that's what the internal rate of return is. So in the world of equity, so equity capital investors typically want an 18 to 24% internal rate of return over the life of the investment. So that's what most investors are looking for. And then they want to see a 10%, 8 to 10% cash on cash return a lot of times. Now that's different investors. Now institutional investors will settle for a 6 to 8% sometimes, and there's people that raise capital from investors and they're paying them 6%, and then they're loaning it back out and making a point or two on that.
Yeah.
That's what a lot of equity funds will do. So it all depends. Now, for an individual like me, I like a 10% return on my cash on cash minimum. I like to see 20 to 30% internal rate of returns. Me, personally, minimum is where I like to be. So you have to work it backwards. And I'll tell you right now, in the United States, with where interest rates are right now, if you put the standard 20 to 30% down and finance the balance, you're going to need at least a 6.5 to 7 cap to break even. That's where your break even threshold is going to be. So, your question was where do you want to be, for break even and all that. That's what you got to know. You got to know, based on your down payment and the interest rates, you do run the calculation to find out your break even. And then as the cap rate goes up, you make more cash flow and on that, on that spread, right? So it all depends on how much you put down. It depends on what the interest rates are, your financing, what the term is, all those types of things. If you got a 20-year amortization, you're going to have less cash flow than a 30-year amortization. So what I just said was a 6.5 to 7 cap with a 30-year like agency loan at 4.5%. That's going to break even at a 6 or a 7 cap. If you've got a 20-year loan, you're not going to break even. You're going to be a little bit underwater. If you're paying interest on the equity portion on that down payment of 6 or 8%, and you've got a service debt at 4.5% to 5%, that's going to be even more difficult, and you need a higher cap rate in order for that to break even. So what a lot of people are doing is they're doing interest only on the balance on a value add for 3 to 5 years to lower that debt service so that it cash flows. So there's ways to get there. So you got to know that. You always have to work the numbers backwards. You start with the net operating income and you work it backwards from there with your financing.